A little bit cheaper. Well, all of the major stock markets down right now, at least 5% for the year. Is this a true sign that the world is broke? And should you dump stocks entirely, just focus on more tangible investments, maybe like gold?
We have an all-star panel ready to go. Joining us, we have Sam Stovall, Chief Investment Strategist at Standard & Poor's, Peter Schiff, President at Euro Pacific Capital and author of How an Economy Grows and Why It Crashes, our stocks editor, Liz McDonald, and our man who carries the bullion, Eric Bowling. Good to see you both. Well, listen, I'm getting the sense that this panel is sort of stacked against equities at the moment, so I'll start with the equities man, Sam Stovall, over at S&P. Are we overstating it, and do you think that as people get nervous looking at a pretty significant correction, now is precisely the time to start sort of adding to your portfolio?
Well, I think certainly with people worried that this could be a repeat of 2008, where we saw a 37% decline in the S&P 500, we have 3 times the decline we've already experienced likely ahead of us. I don't think we can really make that statement just yet. I would tend to say that, obviously, I'm in the equity research side, so I would never say that you want to be out of stocks entirely. I would say that if you wanted to focus on those high-quality issues, look for those companies that have paid, increased their dividends and earnings in each of the last 10 years based on the S&P quality ranks.
You know, but Peter Schiff, I mean, you are the one that is always so cautious about the markets. And look, we could be into bear market territory here, a correction already happening. I mean, is this the time that you say, it's not just this summer, Peter, it's going to be 5 years of this type of environment for the equities market?
Well, we are in a long-term bear market in U.S. stocks for sure that began in 2000 and continues today. You know, the Dow now is worth just 8 ounces of gold, and that means that the Dow Jones has surrendered 100% of the gains that it made from the March 2009 low when the Dow was at only 6,500. So we are at the lowest purchasing power of the Dow right now in a generation, and it's not over yet. I still think that the Dow is going to trade down close to 1 ounce of gold before this bear market is over. And so people have to understand that. But I'm not, totally against stocks. I mean, I'm a stockbroker, so I could be biased, but I still think you want to be in equities. I think you want to be very selective. I think U.S. stocks are going to have a particularly hard time. There are some that are export-related and resource-related that I would favor, but I think in general you want to focus on the economies that don't have all the baggage, that are saving and investing and producing, and most of those economies are in Asia. And the opportunities are there. Also, I'm still bullish on commodities and natural resources, so you want to be invested in companies that profit from the bull markets in those commodities.
Liz, I worry that the problems, the Greases of tomorrow might very well reside in Asia with so much borrowing and so much lending.
Yeah, and those books over there are so opaque, Liz. That's a very important point you're making. The markets right now, we've used the term climbing a wall of worry. You're going to get a nice gymnastic workout climbing this wall of worry, because summer training is always kind of skittish. But when we listen to the big guns on Wall Street, and by the way, pick your data point. We're in a bear market when it dips down to 89.64, and that's from the April 2010 high. But you listen to guys like Thomas Lee, Mark Mobius, Barton Biggs, also Bob Dahl at BlackRock. They're all bullish.
They sure are.
And I'll tell you, Bob Dahl makes a great point. Free cash flow never went negative in this recession, the first time ever. Corporate profits on a V-shaped recovery, forward earnings on a V-shaped recovery. Productivity levels at 1999 highs. Double-dip recessions are exceedingly rare. Only 3 of them since 1926. And Robert Shiller says, when inflation-adjusted GDP comes out of decline, post 3 or 4 quarters of gains, you will not see a double-dip recession. That's Robert Shiller.
But yet, Eric Bowling, here we are in the month of June, summer driving season, and oil is at $72 and change a barrel. I mean, what is going on in the market? I mean, is the economy that bad?
Well, we don't know. I'll tell you, the world is broke. The world economy is in trouble. We're $13 trillion in debt here in the U.S. Yeah, you can roll the dice and maybe pick a bottom in stocks, but that's absolutely crazy. There are a couple of things we do know. In order to bail out, continue to bail out these economies, these countries, and these sectors, we're going to have to print money. When you print money, you debase the currencies, whether it's the euro, the dollar, whatever. And when you debase the currency, things like gold and oil go up. So, yeah, go ahead. Take a shot if you want. And that's, by the way, that's why a lot of these fund managers are saying, yeah, this might be a bottom, because they're invested. They have stocks. They own stocks. You want to take a shot